Welcome to episode 3 of the Tax Smart Daily, a daily video series for real estate investors exploring tax topics that will help you save money and stay out of trouble. I'm Brandon Hall, managing partner at a firm working exclusively with real estate investors on tax and accounting issues. Before we get started, I invite you to subscribe to our YouTube channel so that you'll get notifications when we drop new videos, and be sure to check out the Tax Smart Real Estate Investors Facebook group and the Tax Smart newsletter. Links to both of those are in the description of this video. Lastly, if you have any questions or if anything that I say resonates with you, please leave a comment on this video with a timestamp. I love interacting with our community. Your comments and feedback are my oxygen, and it means the world to me. Today's topic is a question that comes out of our Facebook group. I've been renting a property, but have not claimed depreciation in the past because I didn't want to recapture it. What do I do? There's a lot packed in that question, so let's unpack it. First, let's talk about what depreciation is. When you own rental real estate, you have to depreciate it over 27 and a half years or 39 years if it's non-residential real estate. So 39 years non-residential, 27 and a half years residential. Most people buy single family homes, multifamily homes. You're looking at a 27 and a half year schedule. Depreciation is meant to track the deterioration of an asset over time. So even though real estate appreciates, the building itself falls apart, right? So the value of the building goes up, but my roof deteriorates over time. Depreciation is meant to track that deterioration. Now, depreciation is a non-cash annual expense. What does that mean? If I buy a $100,000 building and I subtract out the value of the land, because you can't depreciate land, maybe the land's worth $10,000, I'm left with a $90,000 building. And I'm going to depreciate that $90,000 over 27 and a half years. And I didn't plan this example in advance, so I don't have the number, the annual depreciation number in my head. But let's call it $3,000 a year. It is going to be my annual depreciation. So if I get to depreciate $3,000 a year, then when I put my P&L together, all my revenue minus all my expenses, I also get to add a $3,000 expense every single year, and that's that depreciation expense. And that just helps to shelter my cash flow because I don't have to fork out additional money to claim that $3,000 every year. I bought the asset up front and I get to write it off slowly over 27 and a half years. So it's a phantom expense that you get to claim every single year to help shelter cash flow. And that's also why real estate, even though it can be cash flow positive, when you report it to the IRS, you could be showing a tax loss. Many of our clients have high cash flow assets, but they're reporting to the IRS really low cash flow numbers or really low taxable income numbers, or they're reporting a taxable loss thanks to depreciation. You can also get cost segregation studies done on your rental real estate to accelerate the depreciation that you claim every single year. You can also use 100% bonus depreciation for components that have useful lives of 5, 7, and 15 years. That's personal property and land improvements. And we'll talk about cost segregation studies and bonus depreciation on some other daily video in the future. So make sure that you keep watching. Subscribe to our YouTube channel. Now, depreciation is required. So the big question we get from investors every once in a while is, should I even depreciate my property? Because I have to recapture it at some point. We'll talk about recapture here in a second. But the answer is always yes. You have to depreciate your rental real estate. It's not a choice. It is a requirement. And not only is it a requirement, but here's why you have a vested interest in depreciating your property. When you go to sell your property, the IRS is going to assess a tax, a recapture tax, on the depreciation that you have claimed or could have claimed. And it's the could have claimed piece that trips people up, because most people think if I don't claim depreciation, I don't owe recapture tax whenever I sell the property. But that's not true, because the IRS is going to assess a tax on the depreciation that you could have claimed, even if you didn't claim any depreciation. Now, what is recapture? What does that mean? Well, depreciation, even though it's a benefit, it's a tax benefit that I get to claim every single year, I do have to pay it back at some future point. There's multiple types of recapture. There's recapture for personal property. That's Section 1245 property. It's called Section 1245 recapture. And that is recaptured at your ordinary tax rate. So if I take bonus depreciation on an appliance, I'm going to have to pay my ordinary tax rate whenever I sell the property on the depreciation that I've claimed. You also have Section 1250 recapture. Section 1250 recapture is bonus depreciation that I've claimed in excess of straight line. And that's on land improvements. That's going to be 15-year property. So if I have a $15,000 land improvement, straight line, meaning that I take $15,000 divided by the useful life, that's straight line. The useful life of land improvements is 15 years. So if I have a $15,000 asset and I depreciate it over 15 years, my straight line annual depreciation is $1,000. If I take bonus depreciation up front, meaning I put the asset into service and then I take 100% bonus depreciation, I write the entire $15,000 off in year one. Then I've taken $15,000 in year one, there's nothing left to depreciate. If I sell that property after year 5, then I have $10,000 of bonus depreciation in excess of straight line. How did I get that? Well, straight line depreciation for this $15,000 asset over 15 years, it's $1,000 a year. I sold the asset after 5 years, so my straight line at year 5 should have been $5,000 of straight line depreciation if I had it over straight line. But in the beginning, I took a $15,000 bonus depreciation. So $15,000 of bonus depreciation minus my straight line is $10,000. I recapture that $10,000 at my ordinary tax rates, as high as 37%, at least today. The third type of recapture is unrecaptured Section 1250 gain. That is depreciation related to the building and straight line depreciation on the 15-year land improvements. So if I depreciate my building over 27 and a half years and I don't do any sort of bonus depreciation or anything, so we don't have to worry about Section 1245 recapture or Section 1250 recapture. I just depreciate my building over 27 and a half years. I take $3,000 of depreciation every single year. Let's say after 10 years, I sell the asset. So I've taken $30,000 of depreciation. I'm going to pay a recapture tax up to 25% on that $30,000 of depreciation that I've claimed. That's the recapture most people are referencing when they're talking about paying this tax on the depreciation that they've claimed. It's the unrecaptured Section 1250 gain. And that's the depreciation, that's the tax on the depreciation related to the building over the hold period. And it's taxed at a maximum of 25%. So it's actually not a horrible thing if you're in the higher tax brackets. Think about it. If I'm in a 37% tax bracket, I take $30,000 of depreciation and I save 37 cents on the dollar. And then I recaptured at 25 cents on the dollar. I've received a tax benefit as a result of this arbitrage. So it still benefits me. It's just important for you to recognize that at some point you will have to recapture that depreciation. Now, how do you avoid recapture? You can do a 1031 exchange. You can buy new property and bonus depreciate it and cost segregate it, and or I guess I said that backwards. Cost segregate it and bonus depreciate it to create a large loss to offset the gain. You can roll into opportunity funds, though 5 years from now that's probably not going to be that viable of a strategy anymore. So there are some things that you can do to push off recognizing the gain. As long as all of those rules that I just said actually still exist 5 years from now. So don't fret. Just know that you do have to recapture it at some point. Now, let's get back to the question. I've been renting a property, but I've not claimed depreciation in the past because I didn't want to pay recapture. What do I do? Well, we just talked about recapture, so now let's talk about what do you do? You're going to have to recapture regardless of whether or not you took the depreciation or not, because again, the IRS is going to assess a tax on what you could have claimed, not necessarily what you did claim. So what do you do? Well, first thing is if you're still within that three-year window, amend your tax returns. You can go back and amend, and you can claim the depreciation, and you can amend each tax return up till today, up till present. If you're past that window, you've got to file a Form 3115. It's a doozy. Would not recommend filing it yourself. So definitely work with a CPA on that. It will probably cost you $1,000 to $2,000. I actually don't hold me to that, because we've seen 3115s that cost a lot, and then we've seen 3115s that cost a little. But the point is that it is a compliance headache, and it can be pretty cumbersome to fill out. But you'll fill out a Form 3115. You will perform a Section 481A adjustment, and you'll be able to claim all the depreciation that you missed in the year that you fill out that Form 3115. So if I've got 10 years of depreciation that I haven't actually claimed, and we're using my same $100,000 example, I fill out a Form 3115. My 481A adjustment for the current tax year is $30,000 because I had $30,000 of missed depreciation. I get to claim all of that in the year that I fill out that Form 3115. You can also wait until you sell the property. So maybe you don't go back and amend your returns. Maybe you don't file Form 3115. You could wait until you sell the property and then file a Form 3115 at that time. Technically, that's not how you should do it. But if you are catching this in the year that you're selling the property, you could file a Form 3115 with a 481A adjustment in the same year that you sell the property. You would basically claim the depreciation and then you'd immediately return it to the IRS via that recapture tax. Thanks for tuning in to today's episode of the Tax Smart Daily. I invite you to leave a comment on this video with questions or anything that resonated with you. Be sure to timestamp it so that I know what you're referencing. And be sure to check out the links in the description of this video to join our various communities. Thanks so much.